Ever found yourself staring at a live candle chart, watching the wicks jump up and down, and just felt your pulse start to race? Well, you know exactly how incredibly stressful emotional trading can be. Making split-second decisions based on gut feelings when the market is moving that fast, it's pretty much a recipe for disaster. But what if we could just completely remove that emotion from the equation? Today, we're going to explore exactly how to transition from chaotic, reactive trading to a highly disciplined mechanical approach. And we are going to do it by mapping out a very specific 1-hour and 4-hour mechanical trading strategy. We're using a real-world setup for the SOL/USDT pair, trading right around the $80 mark. We're going to look at all the real candle chart details, the exact exponential moving averages, the precise entry points, the whole shebang.
Okay, let's dive into our roadmap for today. We're going to walk chronologically through a strict 5-step mechanical framework: setting the long bias, waiting for the pullback, confirming momentum, locking in the entry trigger, and managing risk and targets. Then we'll wrap it all up with a complete trade summary.
All right, starting things off with step 1, setting the long bias. Think of this first step kind of like looking at a macro map before you ask for turn-by-turn directions. When we pull up our real 4-hour candle chart, we use 2 critical levels that act as absolute bias filters. First, we have the 4-hour 50-period exponential moving average, or EMA, which is sitting at roughly $76.20. Then, we look at the slower 4-hour 200 EMA, sitting at approximately $71.40. These 2 lines right here, they are the absolute foundation of our rule set.
Because our current price of $80 sits cleanly above both of those moving average lines, the mechanical rule strictly dictates a long bias only. There's no room for interpretation here at all. Even if the chart looks like it's about to tank, no short trades are taken. We're literally only looking for opportunities to buy.
Moving right along to step 2, waiting for the pullback. So now that our macro map tells us we're only going long, we actually zoom into the real 1-hour candle chart. This is where we start hunting for our specific zone of interest. As the price pulls back, we keep our eyes glued to the 1-hour 20 EMA, which is sitting at exactly $78.50. Picture those 1-hour candles slowly drifting down toward that line. You're watching it closely, but, and I need to be firm here, you are not buying just yet. Simply touching a line is not a mechanical entry.
Which brings us to step 3, momentum confirmation. Before risking a single dollar at our zone of interest, we need undeniable proof that buyers are actually stepping back in. To measure that momentum mechanically, we rely on the RSI 14. For those maybe a bit newer to the jargon, the Relative Strength Index measures the speed and change of price movements, calculated here over a 14-period window. It's essentially our gauge to tell us if the bears are exhausted and the bulls are finally waking up.
And this brilliantly illustrates how a mechanical trigger actually works in practice. Instead of just guessing, we watch that RSI 14. We see it dip down toward 45 during the pullback. Then, crucially, right as the real price action is hovering around $78.90, the RSI crosses back above that 50 midline. That exact mathematical crossing, that's our definitive confirmation that the buyers have returned.
All right, step 4, confirming the entry trigger.
We've got the macro trend, the pullback, and the momentum. Now, we calculate our exact entry point. Looking at the real chart, you mark the prior 1-hour swing high, which happens to be at $79.80. Now, your rule is to enter long, but only when a 1-hour candle actually closes above that specific level, and it has to be accompanied by above-average volume. It's not enough for just the wick of the candle to poke through. The real solid body of the candle must close above it.
Boom! The candle closes, and your precise entry price is locked in at $79.85. Calculating this kind of precision feels completely different from just guessing, doesn't it? It feels like locking exact coordinates into your exchange interface. You know exactly why you're entering and exactly where.
Next up is step 5, managing risk and targets. So the entry is usually the most exciting part, right? But long-term survival in trading requires an exit plan that is way stricter than your entry. To set our stop loss without letting emotions creep in, we use the ATR 14, or average true range. This measures current market volatility. On our 1-hour chart, the ATR is estimated at about $1.20. That just means the price is moving roughly $1.20 per hour. We take a 1.5 multiplier of this value. Why? Just to give our trade enough room to breathe without risking too much of our capital.
So let's do the math. $1.20 multiplied by 1.5 gives us $1.80. We subtract that $1.80 from our entry price of $79.85, giving us an exact, purely mechanical stop-loss level of $78.05. You are taking a strict $1.80 risk per unit. If the price hits this level, you are out. No hoping it turns around, no praying, you just execute the exit.
Now, on the upside, we set our Take Profit 1, our TP1, using a 1.5 reward-to-risk ratio. That puts our first target at exactly $82.55. When the candle hits this price, a mechanical trader scales out part of the position, locking in a guaranteed solid gain.
So the crucial point is how you handle the remaining position once you've secured that first bit of profit. The rule states you trail the remainder using either a 1-hour chandelier exit indicator or that 1-hour 20 EMA we looked at earlier. But listen, there is also a supreme fail-safe here, the hard exit. If at any point the price drops and a candle closes back below our original macro filter, that 4-hour 50 EMA at roughly $76.20, the entire trend is invalidated. You exit the remainder immediately, totally regardless of where your trailing stop was.
Let's wrap things up with Step 6, the mechanical trade summary. We've thrown a lot of specific price points out there, so let's bring all those separate numbers together into one coherent view. This is really the ultimate payoff of our explainer. Your entire trade is perfectly boxed into this incredibly clean framework. Your exact entry is $79.85. Your hard stop loss to protect your capital is $78.05. Your first profit target sits at $82.55, and your absolute trend invalidation is $76.20. When you literally write this out before you ever click the buy button, the emotion simply vanishes. It's just data.
Seeing this chronological flow really highlights exactly how this system builds discipline. Bias, pullback, momentum, entry, stops. It completely reinforces that massive shift from gut feelings to structured rules. Every single action is contingent on a very specific, measurable event actually happening on the real candle chart.
Now I need to address something very directly. Pulling a quote straight from the source material for this strategy. I'm not a financial advisor. This is a mechanical framework, not a signal to act on. The EMA and ATR values we discussed today are illustrative estimates based on recent price action, not precise live indicator calculations. It is absolutely crucial that you plug real OHLC data, that's open, high, low, close, data into your own personal charting platform to get exact up-to-the-minute numbers before you ever consider actually placing a trade.
Because the real goal here is to learn the structure, not just blindly copy the numbers we used as an example. It's about building a system that literally protects you from yourself. So I'll leave you with this question. After seeing just how precisely a trade can be mapped out, will you finally commit to replacing your emotional trading habits with a strict mechanical framework? Just think about how that one shift could change your entire approach. Thank you so much for joining me for this explainer, and keep studying those